Hey guys, welcome back. It's been far too long since I've done a portfolio update, and I wanted to run you guys through how my portfolio has been doing so far in 2026. Right now, I'm 98% invested in AI and big tech, and I just want to let you guys know how that investment strategy is going. Now, year to date, I am up 26.7%. Compared to the NASDAQ, that's almost double of what that's returned, and then the S&P 500 has only returned about, we'll call it 9% to be generous. Now, obviously, this year has been pretty decent for actually a few different types of stocks, mainly stocks like Micron. Basically, it's like the second wave of the AI hardware revolution. So now you're seeing memory being heavily rewarded. You're seeing stocks like AMD. I mean, I remember last year in, I think it was January or February, AMD was at $100 a share, and I made a video about how I was doubling down on my position in AMD, and now the shares rose up to, I think, $550, and right now it's up to $500 a share. So there have been very select names within the AI space that have been doing phenomenally well, and unfortunately, my biggest positions haven't been in them. So that's why I'm only up 27%. 27% is still really good, but it's not the 500% that AMD saw over the last year and a half. So my portfolio on average has been earning 34% per year since January of 2019 when I started it. Honestly, what I'm most impressed with is just the fact that I've basically gotten 3 times the return of the S&P 500 year to date. I'm pretty proud of it, but this also isn't that great of a year for me. But I'm certainly not going to sneeze at 27% in, 7 months. Now, when you break down my actual portfolio, what you'll see is I'm in the same exact names that I've been in forever. I've barely changed anything about my portfolio over the last year. Nvidia is my top holding with a concentration of 41.6%. That's extremely concentrated, but it's actually less concentrated than it used to be. Nvidia used to be up at 50%, maybe 52 or 53 at its peak, and Crowstrike was only probably 20% of my portfolio. VGT is an ETF that I've been in since pretty much 2019, I believe. And that's just grown organically on its own. I haven't added to it for several years now. And it just remains a core position just because it's an easy set and forget. It's a very well-performing ETF. And it also sort of diversifies my portfolio, not in terms of S&P sector, but it does in terms of company by company. So I think there's 200 or 300 companies within the ETF. And so that provides me a little bit of diversification, even though I don't really care about diversification. I don't want to sell it, man. I don't want to pay taxes on the capital gains. I'll just be honest. I just don't want to pay the capital gains. So I've had no reason to sell it so far, and I'm just going to keep it in there because why not? Next is AMD. AMD used to be a far smaller position within my portfolio, but now it's 6.5%. So it's actually a pretty big holding, and that's just because it went from $100 to $500, and here we are. Microsoft has not been doing that well this year. Meta, same. And I got Apple, Google, MasterCard, Netflix, and Visa. Now, Netflix is actually a new position that I took earlier this year. Netflix went from $145, I believe, in October or November of 2025, and right now it's in the 60s. This is a phenomenal company. I'll do a separate video on it, but I took a new position in Netflix. I'm probably down 10 or 15%. I think I bought in the low 80s or mid 70s, somewhere in there, but still a really amazing company, and I think that every single one of these companies has earned its spot within my portfolio, and I'm excited to hold them. I'm excited to be an owner, and I'm excited to see what the rest of 2026 has to offer. Now, the number that's really staggering to me is just the fact that I have 98% of my portfolio in tech and AI. I am a very high conviction investor. I don't mess around when it comes to putting my money in things. I don't like putting my money in tons of different little baskets. And honestly, the fact that 70% of everything I own is within 2 companies should really tell you a lot. I am not risk averse. I am okay with ginormous swings within my portfolio. And also I have some call options, right? I have some call options on A few companies I just closed some on Meta. I gained 40% on, right? That was a good trade. But again, it's a very small, it's almost like fun money that I'm playing with when I buy calls. But I have consistently made money on it. So I just kind of keep doing it with a very small portion of my portfolio and keep moving. When we take a broader look at the stock market, you can see a couple of things, right? The NASDAQ and the S&P both look like they're doing pretty well this year. Pretty average returns, I would say. The NASDAQ up 13.5%, the S&P 500 up 8.7%. Now, these look like average returns, but it's actually a little bit odd, right? Normally, when you look at the market, you see in the S&P 500 that it's gone up 25% in a year or 20% in a year, and then maybe another year it drops 10, 20, 30%, depending on the year, right? And that's how you average out to that 10% average. It's very odd to genuinely see the S&P 500 only up about 10%. It's very weird to see genuinely average returns. What's been mainly driving this from my perspective is just the fact that the global economy is being a little bit shaken by the fact that President Trump has ordered strikes in Iran, that whole war essentially, right? You have the blockade of the Strait of Hormuz. Crude oil went up to $100 to $110 per barrel. That's caused inflation to rise, the cost of goods to rise. It's put a lot of stress on a lot of people, including both the average citizen of the United States as well as, I think, I remember seeing videos a few months ago when the Strait of Hormuz was completely blockaded and there was no oil being transited, that people in Europe were having crazy dollar amounts per liter for their gas. So they were getting harder. Europe was getting hit harder even more than us, which was interesting to see. But there's just been global conflict. And the fact that there's been global conflict and the oil supply chain has been disrupted, that's why you're not seeing the S&P 500 rip to the high heavens. There are some other reasons too, like some AI skepticism. There have been cheaper AI models released by China, whatever. That's another conversation for another time. But by and large, I think the fact that the S&P 500 has not been ripping this year is the fact that geopolitical tensions have been wholeheartedly holding it back. And that's okay. Sometimes you just have to live through these. Now, what's really moving my portfolio specifically is a couple of things. We've talked about inflation, right, because of Iran. The CPI cooled to 3.5% in June, which is down from 4.2% in May. But 3.5% is not what the Fed is shooting for. They're shooting for 2%. And the fact that the CPI spiked because of this conflict just means that the Fed is going to be hawkish for longer. They're going to keep rates higher for longer, and that's not good for stocks. The higher interest rates are, and the longer we hold those higher interest rates, the worse it is for stocks, because that just means that people can put their money in to their bank account, high yield savings accounts, bonds, name an asset that essentially returns a fixed rate. Those are way safer. Why would I put my money in the stock market for an 8% return, but way higher risk when I can get 5% in a bond? It doesn't make sense. So that's been a huge headwind this year for stocks. The other thing is the AI CapEx jitters, right? There's tons and tons of companies that are pouring money into AI CapEx. And the question that remains every single week, every single month, every single quarter when these companies are reporting and giving us estimates on how much money they're actually going to be spending on their AI infrastructure is, how long is this going to last? How long are we going to see hundreds of billions of dollars being poured into AI every single quarter? I mean, it's insane. And then you look at companies like Micron and you're like, oh, well, no wonder they're spiking. But at the same time, investors know this isn't going to last forever. At some point, this is going to cool off. And I think that one of the main reasons that I don't think that we're in a bubble is the fact that these companies are not just flying to the moon. You don't see Nvidia at a 50 PE anymore, right? Nvidia's at a 24 PE. That's a bubble? Investors are very clearly pricing in the fact that this is going to one day end. And they're not getting too ahead of their skis, which I think is extremely healthy for the entire market. Now, I want to go into a little bit of why I own specifically Nvidia and Crowstrike. These are my two core positions. They have remained my two core positions for a couple of years now. Nvidia is literally the picks and shovels of the AI boom. I don't care about Micron. I really don't. I haven't even touched the stock. I was tempted to at one point, but I said, they just don't have as big of a moat as Nvidia. When you look at Nvidia, they have the world's greatest GPUs. Everybody is fighting tooth and nail to get Nvidia GPUs. And people are fighting tooth and nail to get Micron memory as well. But you got to keep in mind, Micron isn't even the best memory maker in the world. Look at SK Hynix in Korea. Those guys own the memory market. Micron is certainly benefiting, but they are not the key player like Nvidia is. Nvidia has probably one major competitor right now, knock on wood, and that is AMD. But AMD has still not caught up. Nvidia's ahead. They have the moat. There's so much money to be thrown around at AI, and also Nvidia is just so far ahead, and they have such a phenomenal reputation, and they keep putting out an amazing product. They have CUDA. Their moat is so wide that they are disruptable, but it's going to take a while for anybody to actually do that, and I don't foresee that happening within the next couple of years. And that's why I continue to have 41% of my portfolio within Nvidia. Now, the second piece of that is, okay, so we have the hardware side where Nvidia is doling out these chips like it's freaking candy to second graders. And then the other side of it is, hey guys, we're building all of this AI infrastructure, tons of it. Tons of AI infrastructure, and AI is going to be used everywhere. But wait a second, tons of people are going to be using AI. AI is going to start posing security threats to computers. Like literally, you look at Anthropic's Mythos 5, literally had to get reviewed by the US government. Fable 5, when they released that, the US government said, hey, Anthropic, you got to take it back. This is way too powerful. Fable 5 had guardrails, and it still had to be checked by the US government. This is how powerful AI is getting, and it's not quite there yet, right? It's not quite as powerful as we might think it is, but it's getting there. And the fact is, it's getting there quickly, and we need people who can secure data and who can respond to the threat that AI poses, especially when it's in the hands of a nefarious actor. And that's exactly why I'm in CrowdStrike. CrowdStrike is an amazing company. They are phenomenal at endpoint security, but more than that, they've been building up their AI infrastructure. They've been building up their database and using AI to help people solve cybersecurity issues forever. And they're the number one player in it. I identified that about 2 years ago after CrowdStrike caused the outage for all those airlines. And I realized that this was a stock that was super cheap for what it's going to end up doing. I started buying into the stock when it was around $60 billion, and now it's up to $200 billion. I do think CrowdStrike is currently a little bit overvalued. However, it's still a phenomenal stock, and I am completely in for the ride. Their future is definitely bright, and I can't wait to see what it brings me. When we look at Nvidia, Nvidia has just straight up been lagging everything. I can't exactly explain why. I just think overall it comes down to sentiment and fear. I think it's pretty normal and pretty healthy for people to look at Nvidia and see, oh my gosh, wow, this is a $5 trillion company and it's growing extremely quickly. And I also think that this whole AI CapEx boom is going to end soon. So it kind of makes sense why it hasn't been taking off to the moon, going to 280 or 300. I think Nvidia is currently underpriced by about 30 to 50%. And so I'm just going to keep holding on and hoping for the best. AMD's been doing phenomenally, but Nvidia, again, is that key player. I'm not worried about this stock at all. It's up 11% year to date. But, you know, a couple of years ago, I was up probably 500% on Nvidia. So an 11% year, you're going to have those. The fact that they're not down 11% is a miracle. So I'm extremely grateful to have invested in this company, and I'm going to continue being an owner of Nvidia shares for the foreseeable future. Now, CrowdStrike. Again, they just had a 4-for-1 stock split, and you can see this stock has been ripping. This is 100% the most valuable player in the portfolio this year just because of its size and also its year-to-date return. It's up to over $200 a share, man. $200 a share. They've been ripping. They've been killing their earnings reports. Everything about this company is running on full steam, and I am so excited to see what happens in this next earnings report. Again, AI-driven security spend is one of the strongest trends in tech, and it is going to continue to be that because people suck, and people are going to continue to do bad things with these really amazing tools that AI is going to give us. The other thing is, even if the AI CapEx boom ends at some point, the beauty of CrowdStrike is just the fact that they're not really selling hardware, man. They're selling a service. They're selling a software. And people are never going to not need cybersecurity. So CrowdStrike is pretty safe, which is why I have put so much of my net worth inside of CrowdStrike. The last company I really want to talk about is Meta, because I think Meta is probably one of the most interesting Mag 7 stocks this year. Meta has been doing extremely poorly. They're down almost 8% year to date. The reason it's down 8% year to date is mainly because of AI spending fears. Meta's been guiding $125 to $145 billion in CapEx for 2026. That's insane. That's a ton. And so investors keep asking, where is this money going for Meta, right? They are not a cloud service provider. They're not renting out their GPUs to other companies. And so the question is, why are you making your own data centers? What are you doing? Is it really making the business that much better? And I think it's a fair question for investors to ask, but number one, the company's growing at 22% per year. Can we really complain? But number two, and this is where this beautiful 20% spike came in. So I actually bought some calls right around here. And lucky enough, Mark Zuckerberg had just announced that they're actually going to start renting out their AI capacity to other companies, just like Microsoft, just like AWS, and just like Oracle. And so the stock saw a very sharp return of over 20% in a very short period of time, which is awesome. So I closed that position and, moved on. But the point is that it really doesn't make sense that Meta is down so much this year. Meta has amazing fundamentals. If we come over here to Allen Global Intelligence and we type in Meta, we can see that this company has been doing insanely well. If you look at their all-time revenue, every single year they're putting up amazing numbers. In fiscal year 24, they grew their company by 21.9%. In fiscal year 25, they grew it by 22.2%. It's just absolutely ludicrous. And the revenue's not stopping. It's actually accelerating. The revenue growth has been accelerating over the past couple of years. It's insane what they've accomplished. When you look at their net income, again, net income's doing extremely well. This business is extremely healthy. When you come over here and look at the free cash flow chart, this is really what people are concerned about. These last 3 years, again, they've been pouring money into AI CapEx. But again, cash flow's going up. When you have a business that is as big as Meta's and it's growing at 20% a year plus, the free cash flow will find you. You don't need to worry where it'll come from. So overall, I understand the fears that people have had with Meta, but I think the fact that Mark Zuckerberg is now going to lease its AI capacity out to other companies and start making money on that, just like Azure, just like AWS, just like Oracle, that decision essentially wipes away all of the CapEx fears, because now, worst case scenario, they just enter the cloud business. Worst case scenario, they just start selling their AI infrastructure. If they don't need it, they sell it. Where's the worry? Overall, Meta is a super strong business, and I think it's one of the most undervalued of the Mag 7 and probably the S&P 100. I mean, if you look over here at its valuation, you can see the trailing 12 months PE over the last 5 years. We can zoom out to 10 years too, but I think the last 5 years is more telling. The past couple of years, you can see that their PE was higher than normal, and now we've finally dipped back into this region where they are below their average trailing 12-month PE. Now, keep in mind, in their last earnings report, they had this big tax that ate into their earnings. So this PE is actually artificially inflated. It should be lower. And when you scroll down and you look here and you look at Meta's forward PE for the next 12 months, they're under a 20. This is an amazing stock to own that is a titan in the ad revenue industry, and you can get it for less than a 20 PE. This is really a no-brainer for me. I plan on adding more money into Meta in the coming months. Now, in summary, this is sort of a comparison of all of the stocks that I have, my core positions. Crowstrike up 65%, AMD up 150%, while the NASDAQ is up only 13% this year, the S&P is up 8.7%, and Nvidia is, kind of sandwiched between the two. Meta has been doing poorly, but again, we're looking at an amazing company at a cheap price. Meta is going to be just fine. I don't think we have to worry about anything. All right, guys, that's all for today. Thank you so much for watching. If you want to use any of the tools that I used within this video, you can go to allenintel.com and check it out. I've been working on this for years now with a buddy, and we've been doing some insane work, I've got to say. We wrap a ton of different tools in one single subscription. A lot of this stuff is free, and we want to keep it free for as many people as possible. You can come here, and if you're a trader and you like charting, you can draw all the lines that your heart desires. We even have our own in-house indicator that we've developed over the past 5 to 6 years. Tons of really, really cool items that we have. This is by far one of the most advanced tools that I've ever used. I use it every single day for my own portfolio management. We even have this really cool feature where you can essentially look around the world and see what different things are happening. So you can see that there was an armed crash in Maine. You can come to different places around the world. Like, let's go and look at near where the Strait of Hormuz is, right? You can see things happening in Iran, all of these things. And you can also filter by conflict. You can filter if you just want political articles. You can click on these things and learn more about the different things, more than just what's happening in the market, but what's happening in the world that's going to impact your portfolio. You can actually go up here and you can type in scenarios. You can click scenarios and you can actually see in real time the probability of different events happening. So you can see, look, the Strait of Hormuz, currently 95%. The strait is pretty much closed, right? And so you can look at how prediction markets are weighing the options on things that are related to this scenario. And you can also see how your portfolio is going to respond to this scenario. So for example, if I go to a Taiwan invasion, right, it's a pretty low chance right now at 3%. That's based on prediction market data. It's based on news articles. We've taken a bunch of data from a bunch of different sources and we spit out this probability. But so right now 3%, but you can scroll down and you can say, hey, if this were to happen, how is this going to affect my portfolio? So you can come here, manage your portfolio, look at it every single day. We'll update you with a brief and you can see there's even a privacy mode for my YouTube videos, right? You can see the headlines that are pertinent to your portfolio. And you can also see, hey, when are these earnings dates coming up? Most sites on the internet, when they do stock analysis, they look at fundamentals. Maybe you'll find a site that does charting for you, but this really encapsulates every single aspect of the market. It incorporates geopolitical events, charting, technicals, fundamentals. Everything you need is in Allen Intel. So if you want to sign up, it's completely free. You can even subscribe and get your first month free off of our pro plan. It's only $30 a month for this single subscription. You get all of these tools. Thank you guys so much for watching, and I'll see you in the next one.